Good evening and welcome to Your Money, Your Call. I'm Chris Kimber. Joining me tonight and Roger Montgomery from rogermontgomery.com. Si, thanks for waiting on the phone. How can we help you?
Hey, good day, mate. I would like to ask both Roger and George.
Yep.
I'm not sure which one to buy at this stage, whether it is Leighton Holdings or QBE Insurance.
Comparison, I think Roger's going to say neither, but let's just ask him.
Neither. Okay, having said that, let me add to some of George's points. Firstly, we'll talk about Leighton's. Leighton's have given guidance for 2012 of about $615 million profit. The desal plant is a real problem for them in Victoria, and I'll explain why. Workers on that site are being paid $200,000, and when that job is finished, they will not be getting $200,000. So there's safety issues, so they have to, come off the site. There's all sorts of issues with that. That I think the only issue is that the workers don't want to stop earning $200,000. So go slows are going to be the par for the course for this particular site, and that's going to be a real problem for Leighton's going forward. The Hub Tour joint venture in the Middle East is another issue for them. They are currently lending, I believe, more money to that joint venture at the same time that they're continuing to write down the assets in that joint venture. And they've already written down by 50% since, I think it was 2007. So that's another issue for them. And then on top of that, you've got Airport Link in Brisbane, and the issue for that is that, again, that was another infrastructure project where they had really optimistic forecasts for traffic, which just won't be met. It could mean that the whole thing goes bust shortly after it actually launches, and Leighton's have a capital commitment, a capital guarantee, if you like, of $200 million, which I suspect that they'll have to write off. So it's not over for Leighton's in the next 12 months, and there's some real issues for the company. So that's the first thing. Second thing is that if they do hit that $615 million profit target, then they're trading at about their intrinsic value now. And so they could be reasonably priced or fairly priced if they're going to hit that 615. But as I've said, they may not hit that 615. For QBE, you want to buy insurers when you're at the low point of the premium cycle. So over the last few years, and I mean going back to 2007, you had a dearth of catastrophes globally. You had cheap funding coming around from everywhere, so there was funding everywhere. So insurers were insuring at very low rates and offering very cheap premiums, and it's very hard to make money. On top of the fact, as George alluded to, that you've got very low rates on your bond portfolio in the United States, and the majority of QBE's investments are in US bonds. Now, I think after 2013, there's a very real risk of inflation in the United States. That means bond rates will go up. That'll be good for QBE. We've also had a bunch of catastrophes, which means that all of that cheap funding's been sucked out of the insurance sector, and that means premiums are starting to go up. And we see QBE's announced that recently, that premiums are starting to go up. Doesn't mean they're going to make a whole lot more money in the next 12 months, but I think over the next 5-10 years, you'll see QBE. This was very close, if not a low point in the premium cycle for QBE. So out of the two of them, I think the lower risk opportunity is QBE.
On the line from Melbourne, how can we help you?
Thanks very much, Chris, and thanks for taking my call. Good evening to the panel. My question to both the guys is on a company called Corporate Travel Management, CTD. I own some shares in that, and it's a business that impresses me with its vision, and as does the management. So I'd just like some views on that. Thanks.
All right, great. Thanks very much for your question. Corporate Travel Management. Sorry to say, it's only listed there in 2010.
Late last year.
So Roger, what's it look like? I haven't looked at this at all.
It's an A1 company. It's a business that if I could have bought it in the float, I would have. Alas, didn't get the opportunity. George, you might be able to sort.
I'm not too familiar. I'm
hoping you can get me some stock next time in a good
next
float.
He's just setting up an account with you. It's an entirely separate thing.
We're good with that.
So look, intrinsic value $1.58. Rising to $1.90 and then to $2.18. It's trading at about, I think about $1. Is it $1.76? Does that sound about right to you?
Yeah.
Does that sound about right? So it's trading a little bit higher than its intrinsic value this year, but I've got intrinsic value rising substantially over the next couple of years, and it's an A1. We only have a handful of A1 companies in the Australian market. This seems like one of them. It's an A1 business. The Aussie dollar's not helping, but it's cheap compared to our estimates of its intrinsic value. They keep, they're not employing the incremental earnings as profitably as I would like to see, and that's a function of what I've just quite facetiously described. But long-term, great quality business, and it's not particularly expensive.
I would have thought AW would be quite hard to value, seeing as they're putting holes in the ground, and
we've got a valuation on it, but unfortunately, it's going to generate a return on equity over the next couple of years. It's sort of single digits.
Yeah.
$700 odd million has gone into this company over the years. Shares on issue have gone up tremendously from 218 million to 521 million or thereabouts. It's just not a quality company for me. All of the criteria that I look for in a company, its intrinsic value is the only stumbling block for me. So when I look at its capital history and what it's done with the funds that it's got, it's just increased its intrinsic value every single year, and that's the sort of business that we're after. It's just not cheap at the moment. Unfortunately, I've got an intrinsic value of about 65 cents. Now that's up a long way from back when it was probably about 6 cents a couple of years ago. So it's a business that's increasing its intrinsic value tremendously, but it's just the price has gone a little bit ahead of itself. Linus, as I said on that program, and yes, I have spoken to a number of people about this particular company, but as I said on the program, it's dependent on the prices of rare earths remaining high. Currently, it is in China's interest to keep prices for rare earths high, but that won't always be the case. And so you've just got to be mindful of the fact that there's a lot of stocks go up in anticipation of production, but in between where the price is high and production occurring, anything can happen to the commodity price. And so you've just got to be mindful of that risk. If the price stays high, if it hits all of the earnings forecasts that all those brokers were expecting, then $6 or $7 would be its intrinsic value. But a lot of ifs.